I appreciate that you said it's a more nuanced question, because it really is, and it's different for everybody. And so one of the things that I've uploaded into the group is my TROI calculator, so a total return on investment. And I want to show you this because I don't think you've seen this. So this calculator right here is we're really just looking at these columns. So for your 1 year return, this takes into account the 4 pieces of return that you're getting, right? We've talked about the cash on cash return, but you also have appreciation, debt pay down, and your tax hedge return, right? So let's actually do this for your property and see what it would return. What's the property's value?
Probably around 220.
Okay. What was your once you refinance out, what are you going to be all in?
About 30K.
Okay.
I think.
And what do you think it'll cash flow if you get it rented at 1875?
Hold on, I have this. Let's say 300. I think.
Okay.
I'm not exactly sure, but I think that's
okay.
Right.
So let's be a little bit conservative and say it's 250. And yearly appreciation. I've talked about this a little bit, but appreciation really has 2 components. It has a true intrinsic value, like the increase of true intrinsic value, being that your market is becoming more valuable, more people are moving there. Think about, say, Dallas, right? Dallas, a lot of people are moving there. I want to say something like 8% of US GDP goes through Dallas, some absurd number. So it's becoming more and more valuable. That's the intrinsic value of the property. The second piece is inflation. And usually this number we don't care about as much, but right now it's way more substantial, right? Inflation is at 9.1%, to the point where today the Fed announced they're increasing rates another 75 basis points, right? So adding those 2 things together, let's say your market only appreciates in true intrinsic value 1% this year, but inflation is at 9% for the entire year. That's a 10% appreciation overall. I think, a conservative yearly appreciation right now, I think we can use 6%. We can be even more conservative at 5%. Your loan amount for this would be,
once I refinance. Yeah, you got it.
75% of that. Okay. And your loan rate, you're getting a personal loan, right?
Yeah.
Let's just say it's something like that.
Yeah.
We'll kind of ignore this. This is a little bit, if you did a cost segregation analysis to offset some of your taxes. So in this situation, what you'd be seeing is a 10% cash on cash return, right? So it looks like, well, maybe that's not that great, but of that 30 that you leave in, if your property increases 5%, you just made 11 grand, right? So you made over 30% there. So in the first year, your return will be 73%. And a lot of that is coming from your tax hedge, because your loan rate is high, right? Meaning a lot of your payment is going to be going to interest, and not a whole lot of your cash flow is going to be able to cover it, right? Or your disproportionate balance is in favor of interest rather than cash flow. So you're going to have a lot more tax hedging abilities, right? So that's what it looks like over the first year, right? If we were to look at that over the course of 5 years, it would be in hundreds. But of course, it's just, that is just going to happen. So I like to look at it in terms of 1 year ROI. Now, if you did sell it, how much would you get back?
Like all expenses paid?
Yeah. Like how much would you walk away in your pocket?
About 30K, I think.
Okay. So 30 grand, essentially the question there is, could you turn 30 grand into more cash flow than you would be making on this property? $300 a month. You could probably, around that much, if you were to just use that as a turnkey, right? And just go ahead and buy something 20% down. But you lose some sales costs. You would have to go through the 1031 process, 1031 exchange, which isn't horrible, but it puts you on a timeline, right? You're kind of restricted there. So if you're going to make 30, as opposed to the numbers that I just saw, I would probably still focus on keeping and renting it.
Yeah. Okay. That's good. That total return is really helpful. Is that on the website now, Blake?
Yeah, it's up in the program. It's in the, I believe the deal analysis or the financing section.
Okay, perfect. Yeah, that's really good. Very helpful. Yeah, because I didn't really know how to evaluate the numbers, because it's somewhat subjective. What am I comfortable with in terms of the cash flow?
Yeah.
But yeah, that total
Well, and
return.
what that does is you can, our tendency is to want to think in exact values, and that's just not really how market fluency, like fluency with the market works. You have to make reasonable assumptions, right? You know
Right.
this. You've got an academic background in engineering. Making those reasonable assumptions is part of that as well. So you have to say, well, how much is going to appreciate? I mean, if, for example, we in that deal calculator, if we assumed what Goldman Sachs says, which is over the next year, home prices will appreciate 16.4%, those numbers look way different, right? This is what we just did is a very conservative evaluation of what we think the market might do, right? So that's pretty fair. You can then be really aggressive, and then your like worst case scenario, even if you were just to break even on cash flow and not make anything, you'd still have a 50% return probably in the first year, just because of how everything else is positioned. So understanding the main components that go into what your true return is super helpful, particularly in a market like today's, a market where inflation's going crazy, appreciation is high, rates are really high, and your cash flow is lower than normal.
Right. Okay. Cool, man. Thank you so much.
Awesome.